So that's the money market. Now the capital market, you can see, is somewhat greater in different types of categories. It's got some government securities, it's got inflation-protected government securities, federal agency debt, and also bonds issued by companies, cities, and even internationally. So this is a subsector of the fixed income market, just as the money market is. And this market has different characteristics. The first and sort of most fundamental difference with the money market is that the capital market is long-term. Now, if we define short-term as maturities with 1 year to go or less, of course it stands to reason that then the complement, long-term, would be maturities of 1 year or greater. Now, the capital market is also considered liquid. In other words, it's easier for you to dispose of, let's say, a 30-year bond than it is of a house. But relatively, it is less liquid than the money market, but more liquid than maybe some real assets. And it is also low risk, depending, of course. There's things like junk bonds, which are considered potentially quite high risk, bonds that are issued by companies that could be more likely to go bankrupt. And simply because there's sort of a longer time horizon involved until you get your money back if you put it in the capital market than if you put it in the money market, that means that you do run more risk of not getting your money back as you do in the money market. But generally, it is a lower risk than, let's say, equity. Primarily for the reason that if you, as we talked about, if you're a debt investor, you have primacy over an equity investor in receiving any cash flows from the real assets that make up the company. Should the company actually not be able to pay everyone, the debt holders come first, and only then the equity holders. But because there's a longer time horizon involved, that means debt in the capital markets is still not quite as low risk as debt in the money markets. So the first category that we saw in that star chart of different types of securities traded in the capital markets are Treasury notes and Treasury bonds. Now, Treasury notes have a maturity of up to 10 years. So I guess it can be 0 to 10 years maturity. And Treasury bonds have a maturity of 10 to 30 years. Now, these bond instruments have what's called a par value, which is to say how much money they actually represent in borrowing. And that's said to be $1,000, which is to say each bond itself represents $1,000 of borrowing by the Treasury. Now, interest on this loan is paid semi-annually, so that means that you get 2 coupon payments per year. And the quotes for these bonds are in percentage of par. Now, primarily this is because generally we'll see when we talk about the math of it that bonds are quoted not in dollar amounts, but percentages of par, mostly to account for variations in par value, which is to say variations in the amount borrowed through the debt instrument. So that makes them comparable. If you know that a bond sells for 98% of par, you don't really care if it's a bond to borrow $1,000 or $10,000. You can relate it, one bond to another, much more easily. So that's why they're quoted in percentage terms rather than in dollar terms. Now, another type of treasury bond that we saw in the chart is inflation-protected treasury bonds, which are called TIPS, Treasury Inflation-Protected Securities. Now, these are essentially bonds that offer you whatever interest rate they promise, plus just an adjustment for the rate of inflation. So, as it says on the tin, so to speak, they're protected thereby from inflation, because if inflation goes up and your interest payment does not, you're essentially losing some money because now the money that you're receiving is worth less. And you could have gotten more in interest in the debt market now than what you got when you committed to lend at this relatively lower rate in the past with a lower rate of inflation. So an inflation-protected treasury bond, by adding the rate of inflation to the interest that they repay, essentially ensures that you will be made whole even if the rate of inflation does go up. Federal agency debt, what that means is debt by government-sponsored enterprises, things that are related to or maybe run on behalf of the US government, but are not actually the US government. So a couple classic examples are Fannie Mae and Freddie Mac. Now these are essentially still run by the US government. They invest in and guarantee mortgage-backed securities. So debt from these agencies is considered to be similarly safe to US government debt. And international bonds, things like Euro bonds, Yankee bonds, that's the idea of debt that is issued by a company in a different country. So for example, if you have a German company, but it issues debt in the US and is denominated in US dollars, even though it is a claim on the real assets of a German company, that's a Yankee bond. And similarly, a bond that is issued by a US company in Europe and denominated in euros, even though it's a claim on the real assets of a US company, that would be a Euro bond. So why do these bonds exist? Well, mostly to unlock foreign capital markets for borrowing. If you are an investor in the US, you might not want to really borrow, or you might not want to lend in euros, but you might want to lend to a German company. So if a German company comes along and says, I will sell you a US dollar denominated bond, you might like that better than if all they did is sell euro-denominated bonds in Europe. So this makes the debt markets more liquid by essentially widening the pool of available investors. Now, municipal bonds, those are issued by state and local governments. Essentially, these are bonds that tie to the real assets owned by the state and local governments, and they are used by them to raise money to maintain or acquire new financial assets. Now, it's important to know that the interest on municipal bonds is actually exempt from federal income tax in the US, and even sometimes from state and local tax. Of course, to compensate, municipal bonds usually offer a lower promised interest payment overall, but essentially then what you do is you compare the untaxed interest that you might earn on a municipal bond to the taxed interest that you might earn on any other bond, and look at which one might be more attractive. And if you face a high tax rate, well, then municipal bonds may well be more attractive to you. So interestingly, actually, the rate of return differential between municipal bonds and other bonds really depends on how high the investor's tax rate is. What are the types of municipal bonds? Well, there's mainly two. First of all, there's general obligation bonds, which are pretty much just backed by taxes. So a state or local government will collect a certain amount in taxes, and they will promise you that if you lend to them, they will pay you the interest payments out of those taxes that they generate. Now, generally, this is, of course, very low risk because most of the time, people will pay their state tax, people will pay their city tax. One caveat to that is that during big economic disruptions, tax collection will go down, not because people aren't, they're not refusing to pay their taxes, but more because there's simply less economic activity to be taxed. So general obligation bonds are safe because they're backed by taxes, but tax revenues themselves are still vulnerable to economic cycles. So that means that general obligation bonds are not completely risk-free. And in fact, some cities have considered or even have gone through bankruptcy, which would mean that their general obligation bonds would be defaulted on, just like a company's bond could be. Now, a revenue bond is backed by the revenues of a specific project. So you might have something like a toll road, and you might finance the building of that toll road with a municipal bond issue, and you might tie the revenue from the tolls collected to the debt interest paid on that particular revenue bond. So a general obligation bond is sort of drawn out of the overall tax pool of the state or local government, whereas a revenue bond, its interest comes from money generated by that project specifically. And that can be somewhat safer because even if, let's say, the whole state or the whole city is not doing as well, if the road is still collecting tolls as usual, then the revenue bond that financed it and that has that claim on that real asset will actually still continue receiving its interest payments, even if a general obligation bond by the city or state might be in trouble. But if we sort of look at their distribution, we generally see that in pretty much any given year, there's way more general obligation bonds in terms of sort of total amount of debt outstanding than there are revenue bonds. But you can see that the relative amount is actually rising. Now, corporate bonds are issued by private firms. Similar to Treasury bonds, they make semi-annual interest payments. Because they're not a government entity, but actually a private one, they generally have higher default risk. mostly because historically we've seen very many companies go bankrupt, we've seen far fewer governments go bankrupt. So the probability of default of a government is higher, probability of default in a private firm is higher than in a government. And that, of course, usually means that the yield offered by a corporate bond is higher than the yield offered by a government. And sometimes, though not always, corporate bonds come with options. Now, we talked about options just a little bit before, this idea that there is an asset that derives its value from an underlying financial asset. And so here's what optionality in bonds is. The two classic optionality provisions in bonds are callability, which is to say the private firm that issued the bond can actually request it back. Of course, it'll pay you back the amount you borrowed, but let's say that you initially committed to lend to it for 20 years. Now interest rates are low, so they think that, hey, we can borrow more cheaply. And if at the beginning this bond had a callability option built into it, well, then the company can choose to exercise it. They'll pay you back your principal. They'll, of course, pay you the interest that has accumulated up until they've chosen to call it. But then, then things between you are done. They've paid off their obligation. Now they're free to go and maybe borrow money at a cheaper rate from someone else. You've got your money back, and now you have to do something else with it. So a callability option is something that's of value to the issuer, the private firm borrowing using the corporate bond. Now a convertible is an option that's actually of value to the investor, the person who bought the corporate bond. And what that is the option to convert your bond into equity, should you choose at a certain point in time. Now, why might you want to do that? Well, let's say that a company promised you a certain relatively low interest rate at its outset, and now it's grown really well. It's making huge earnings. It has huge growth. The equity is actually looked at very favorably by the market. Well, now if you're still stuck making a low rate of return on a fixed income obligation from this company, you might get a little jealous, as it were. So what convertibility does is it lets you participate in the upside of equity by giving you the right, if of course this corporate bond had that option built into it from the beginning. Both of these options must be written into the debt contract from the get-go. They can't be bought later on. But if you do have it, then you can actually convert your interest-paying bond into equity. And if the company is actually doing really well, that might be to your advantage. So these options don't exist in government debt, either issued by the Treasury or by municipalities, mostly because municipalities and federal government don't really have equity, right? But private firms do. So they can actually offer their investors an option for convertibility. Usually that's compensated by a lower yield because convertibility is attractive to the investor, whereas callability is often accompanied by a higher yield because callability is attractive to the issuer. Now, mortgage-backed securities are a type of longer-term debt instrument. They're essentially sort of like shares or proportional ownership of a pool of mortgages, which are loans made on the real underlying real asset of real estate. And the main reason that they come about is because whoever actually originated that loan for the purchase of real estate doesn't want to hold it on their books necessarily. So a large number of these were issued by those federal agencies, Fannie Mae and Freddie Mac. Some are issued by banks. And if a bank wants to keep issuing new mortgage loans, at some point they're going to use up all their capital lending to existing mortgages. But what securitizing and creating these mortgage-backed securities lets banks and federal agencies do is take an existing pool of loans, sell it off to somebody else who wants to then buy these mortgage-backed securities that are effectively pooled and then owned, or that represent collective ownership of these underlying mortgages. And then using that cash flow from the sale of mortgage-backed securities, they can then lend more and create more mortgage loans, and then securitize those, get the money back, lend more again. So in a way, the benefit of securitization is that it makes lending more liquid. It lets a bank continue lending even though it might have used up its capital already. If it had to hold the loan to maturity, it might not be able to lend for another 30 years. By securitizing, getting the cash back, and lending again, that effectively increases the supply of loans in the market. But of course, as we saw in the financial crisis, mortgage-backed securities come with substantial downsides if one isn't careful about just how the underlying pool of mortgages will behave and what you might expect as the yield offered by these mortgage-backed securities. Now, most of these are what we call conforming mortgages. In other words, they have a certain set of characteristics, a certain maximum loan size, a certain credit worthiness, minimum credit score. However, some non-government issuers effectively created a lot of subprime mortgages. In other words, non-conforming. A big difference is that oftentimes those borrowers had low credit scores or maybe not a reliable source of income. Of course, these mortgage loans are much more risky, and therefore the mortgage-backed securities that represent a claim on those loans are much more risky as well, in a way that, of course, means that it encourages the creation of these types of securities and introduces a risk that had gone underappreciated in the financial crisis. So Fannie and Freddie actually were encouraged to buy subprime securities from, let's say, banks that issued these relatively low-quality mortgage loans, and that created more credit risk in the economy than people were aware of at the time of the financial crisis. Now, if you look at a plot of mortgage-backed securities outstanding through time, generally you can see that there's more and more securitization occurring all the way up to the financial crisis. Things sort of peak in 2008. And you can see sort of a notable divergence. The federal agencies that issue generally higher quality mortgage-backed securities that are backed by these conforming loans, in fact, have been issuing more. But what's gone down is issuance by these private lenders that may have been targeting people that, or organizations that didn't have as good credit, didn't have necessarily the sources of income. In other words, the bad type of lending has actually subsided. So what does sort of the big picture of the fixed income market look like? Now these amounts are all in billions, so then you can see that, for example, there is 13 then trillion in Treasury debt, about 4 trillion in federal agency and government-sponsored enterprise, GSE, mostly mortgage securitization debt, about 6 trillion in corporate bonds, about also 6.7 trillion in mortgage-backed securities, and about 3.5 trillion in tax-exempt, which is to say things like municipal bond.